Alright everybody, welcome back. So in this video, we're going to have a discussion about different ways to trade options, especially in the current market environment. The example that I'm going to show you was started as a day trade, and then I decided to keep it, and what I did with the trade afterwards. Alright, so we're looking at Tesla, and it was February 16th at around 2:07 in the afternoon. Now, I'm going to show you the picture of the trade in a moment. I'm going to point out I don't live in the Eastern time zone, and my broker shows timestamps of when the trade happened in my time zone, and I'm 1 hour behind the market. So in the picture, it will show 1:07 p.m., but that was 2:07 p.m. in the market time. I'm on a 5-minute because that happened a while back, and on Thinkorswim, if I try to go to a 1-minute that far back, it won't let me. So we're using a 5-minute. It's not going to be perfect, but it's close enough. So we're looking at Tesla, and I bought a call right in this area. It was 1:07 my time, so 2:07 market time. I went long Tesla here. The call that I bought was the 910 call, and we were breaking out from the 908 area, 909. We could argue that it was close to 910. This would be an at the money call. All right, so if it was really far out of the money, if I had bought like a 920, 930, 950, we could say, okay, that was really far out of the money. And if I bought something like a 900 or a 905 or whatever, then we could say I was pretty good in the money. This is really close to being at the money. I don't remember if it was exactly in or just outside, but I would argue that it was probably just outside. So that would give us something like a 45 to 50 delta, and that's where the day was. Okay, so I bought the call, and I spent 49.99. That's $4,999. This is a picture from my broker. It's Tasty Trade or Tasty Works. It doesn't have paper. It's a live trade. It's a live account. I bought this option February 16th at 1:07 market time, or excuse me, 1:07 my time. It's 2:07 market time, and it's red, showing that I paid a debit to buy to open. BTO, it says it right there, and it's the call side. It's the 910 strike. I was 23 days from expiration on the day I bought it. Okay, all of that information is presented just by looking at the picture. The trade happened on it was the March 11 contract, which was 23 days from expiration, and it was the 910 call bought to open for $4,999. Not even 30 minutes later, it was actually 20 minutes later, I rolled the call. So let's zoom in a little bit and examine what I did here. I took my March 11 and I rolled it forward to February 18. That took my 23-day trade down to just 2 days to expiration. I also rolled from the 910 out to the 965. Okay? And I accomplished this roll for $51.63 total credit, not a debit. Okay? Now remember what I paid to open the trade. I spent $5,000 to open it, and then 20 minutes later I rolled it, and they gave me money of $5,160. This is now a long call that I'm holding for free, and I cannot lose. The reason I cannot lose is because if it's out of the money, the call is going to go to zero. If it's out of the money at expiration, the call is worthless. It goes to zero, poof, it's smoke, the trade is closed, and I keep all of that credit, the credit being $161. Why is it only $161? Well, I have to get my money back that I spent to open the trade. The original trade was $5,000, so when I rolled for $5,160, I first recaptured my original $5,000, and then there was a surplus amount of credit, which I got to keep at expiration. Now, the trade could have made even more money, right? Because I'm still holding a long call. It doesn't matter that I'm holding it for a credit. It matters that I'm holding a long call. So if Tesla had continued that rally to the upside, my long call could have become even more profitable, and I would have closed it for an even greater amount of credit. That's not what happened, but that's what I was hoping was going to happen, right? That's why I kept the call in the first place. So back to the chart. We were just coming up into this Globex resistance, and I was worried that we weren't going to really make it through that area, but I didn't want to close the trade down because I thought, well, this could continue maybe tomorrow or for the rest of the week, and while I could just close my trade and lock in the profit, I seen the potential to do more, and so I kept the trade, but I rolled it, okay? And that got us through the rest of the day, which happened to have really been the high of everything, and we sold off from there. Now, the really cool thing about owning an option is that you can use it for collateral. If you wanted to just straight up sell options, you need to have enough capital in your account to buy 100 shares so that if you're wrong, you can cover the short, right? Well, in this case, I have a long option, and that is coverage. It's collateral. I don't need to have to worry about 100 shares of stock. My long option provides that. So now that I own a call, I can sell calls against it. The next day, I had a busy morning, so I couldn't sell really early in the morning, but I did get around to selling. My first short was sold in this time frame, and then I closed that short call out a few minutes later. I think I'm missing a line here, so I'm going to add a line and just bring this over, something like that. Let's check, okay, because of course there's pictures. So the next day, on February 18th, right, remember we were at February 16th, and then we rolled on the 16th, and now here we are on the 17th, the very next day. And we have a February 18 option at this point because we rolled to the Feb 18s at 10:35 in the morning or 10:25 in the morning. I sold to open. The 9:25 call for $480. So I'm selling to open a call here using the 9:25 call, and I did that at 10:25 in the morning. So back to the chart, 10:25 in the morning, I sold a call here, and just moments later, I bought that call back, closing the trade down with a profit. Now I'm busy through the day. I can't just sit around babysitting trades all day, right? So this was like to me, a small scalp, and I get it. I know you guys scalp, like serious hotkeys and all that stuff. That's not what I'm doing here. I marked the wrong close. So let's go in and get the close put in the right spot. I closed it at 10:51 in the morning. So back to the chart. This is 10:50. It shows 10:55, 10:57. So I'm off one candle. Let's move it over. And the way Thinkorswim works is if you draw a line and you snap it into the center of the candle, it actually puts it in the middle of the time frame. So this is a 5-minute candle, and it's showing on the clock up here 10:52 a.m. That's close enough, right? It's close enough. It matches close to the picture we had here. 10:51, 10:52. That's right around the area that I closed it. So I sold it over here, and I bought that back over here. When you sell a call, you want the market to stay below that call, and I sold the 9:25, which is like way up here. All right, let's go back and look at that picture again. I sold the 9:25. So this is the strike that I sold. I needed price to stay below that line. Price did stay below that line, and it moved farther away from that line, and I was able to buy the trade back, close it for a profit. I sold for $4.80, bought it back for $3. That gave me $180 profit right there. And then on the same day, February 17th, at 12:11 in the afternoon, just past lunch. I got to move that line over one line because it was 12:11. I sold a call here, and I ended up buying it back. Surely not that late in the day. Let's go back and look. When did I buy it back? At 3:08 p.m. So I guess it was that late in the day. Okay. We can see, maybe one candle off. This is where I closed that short call. So I sold a call, and then I closed it here. I sold a call, and it rallied against me a little bit. Nobody likes that. But it still stayed a long ways away from me. Which call did I sell? In this particular situation, I sold the 900 strike. Where is the 900 strike at this point? Right here. We'll just take my yellow line, move it closer to the 900. So that's the call that I sold, basically right there. Price rallied a little bit to me, but not too much, and then it continued to go away. Notice my call is above this pivot point. If we were going to see a rally in the market, I was going to lean on that, on the expectation, or the hope, perhaps is a better word, that we would hit that and then reject there and continue to fall. It never got that far, it never got that close to me, and then it fell away. We got past 3. I don't really like to hold trades into power hour. I went ahead and closed this trade down again for a profit. I sold for $770 and closed for $470. That's another $300. So earlier in the day, I made $180. Later in the day, I made another $300. These are just little bites to go along with my free call. Obviously, if Tesla had kept running through the next day and we had just a good clean bullish day, I would not have needed to sell calls, but I still could have. I just would want to stay far enough away from the market, right? So then we get into the Friday, 12:18, and I start selling calls at 10:30 in the morning. That's usually about right because my mornings are pretty busy. I don't like to trade usually in the first 30 to 45 minutes, maybe an hour. And a lot of times I'm just too busy to get any trades done, even if I want to. Right? So which call did I sell? Let's come back over and look. I sold the 880, sold to open, and I sold that for $275. Again, it's a call that I'm selling. If I sell the 880, where were we at the time? We were way up here, and it was just above that pivot, right? That's important to me. Again, if I sell this call and price starts to go up, that's not good for me. A little bit of protection that I had was this pivot minor, and then I had the 5-minute open range bottom, and then I had this pivot minor before price would get to me. So could this be a trade that would perhaps lose? Yeah, I mean, price can do what it wants, but I was trying to hide behind as much structure as I could. I wanted to sell a call as close to the money as I could get so I can get more money in the credit. But on the other hand, I wanted to stay far enough away from price and then hide behind as many things as possible because Tesla is one of those products that can really move, especially when market sentiment just flips over. All right, so I sold a call and I bought it right back moments later. I sold to open at 10:26, and 2 minutes later, I bought it back for $75 profit. I can't remember because it's a long time ago by this point, but I believe something got my attention and I had to quit watching the market, and I just went ahead and closed this trade with profit. I'm totally okay with that. I don't want to leave something like this unattended, and if I get busy or if something comes up and I've got to deal with it, then I just close trades out, especially if they're profitable. So later in the day, I yet again came in and sold another option. Here is February 18th at 11:25 in the morning, and I closed the trade by 11:57 in the morning. Sold to open for $780. bought it back for $6.15. That was another $115 profit. So on this day, I had already made 75, and then I added in another 115. It's not wow money, right? You know what I mean? Like, these are just little bites, little bites. And as you can see, there's plenty of opportunity here to trade. But now we're in Friday afternoon. On 0 days like Fridays, I tend to trade a lot of the SPX and things like that. So I didn't come back in and do any more trading in here. Besides, we started going to the upside. Not particularly a good idea to sell a call on top of the market, right? Um, Tesla, again, is one of those companies that can run you over. So I just avoided the whole thing, went and traded a different product. But this is generally what I like to do. It's not the only thing I do, and it's certainly not the only way that I trade options. But you get a market like Tesla that can make a big move very fast. My original call way back here, I bought that thing. We had an exaggerated move, and at that point, I could just close it and take my gains. But this could have turned into a mega move, right? Like if we had done puts instead of calls, say I had bought a put on this day and we kind of got into the close or into the later part of the afternoon, I wanted to keep it, I roll it, doing exactly what I did with that call, and then the next day I'm able to make even more money because I didn't close that put down and I rolled it into a no-lose trade, which gave me the confidence to hold when we started to actually get ran against, right? Because at that point, it wouldn't matter if it ran against me. It wouldn't matter if it runs all the way up. I've already rolled it. It cannot lose, and everything would be fine. I don't have to stress, right? And I have the confidence to hold the trade because I know I can't lose that trade. And the next day would have just been a phenomenal follow through. Everybody knows that, when you trade options in Tesla, those single options can make mint, right? They really can make money, but they can hurt too. And by doing a roll like this, I get rid of that hurt. I can sleep like a baby at night knowing I have no risk. Plus, on top of that, I can sell options against it if things aren't making me more money, which is what happened here, where I took the call, we rallied up, and then for the next 2 days, we just fell and fell and fell. Hey, fine, no problem. I made money on that too, right? So that's the way it works. If you notice, I didn't really talk too much about the Greeks, and that's because there's no reason when we're looking at something like this that has 1 day or no days left, there's no reason to dig too deep into the Greeks, right? What you want to focus on is how comfortable are you with the thing that you're selling. Watch your buying power. If the thing that you're selling is really far from the thing that you own, your buying power could get increased substantially or decreased, right? You can lose a lot of buying power during the sell while you've got other products open, right? So that's important to get into. But other than that, I like to hide behind structure. I like to keep my eye on what time of day it is. And, dangerous areas like the first hour of the day, the last hour of the day, pauses and sideways time frames like the middle of the day are great for short duration sales like an hour, maybe 35, 40 minutes. And I'm really focused on how much money am I going to get. I want to get as close to the money as possible to get more credit, because also things that are closer to the money are going to respond to that decay better, right? If you're really, really far out of the money, they're not going to decay as well right away, and you're not going to get as much credit, right? So that's it. Short, sweet, simple. No reason to stress on all the other Greeks and all that stuff just because we're talking about some very short duration things. I appreciate your time, guys. I look forward to seeing you at the next one.